really hear you well. Let me use my headphone. Hello? Can you hear me?
Yeah.
How are you too? Let's see. Okay.
Ahmed, how are you? Excuse me, sorry.
Let me just get out of here.
Hello?
Hello? I'm trying to move away from noise. Sorry.
Sorry, can you hear me?
Yes, clearly.
Great.
I can.
So, good evening. How is your Sunday going?
Not bad. I've been trying to chat up for the week.
Okay. Mohammed, how are you doing too?
Fine, bro. Fine, bro. Fine, boss.
Good to hear you. All right, so this class is just specially for Wumi. She requested for how does the EMA works, right? But I thought to myself, why don't some other close associates or close member to benefit? So the first thing that the EMA is for is to just measure averages, okay? And what I mean by averages is when we look at the number of trading days that occurs in a month, we've got about 21 trading days in a month, okay? So if we want to know what the real reflection of price is over a period of 21 days, we might not be able to know the real reflection of price where the current price is. But when we employ moving averages, then it will be showing us how far we've gone away from a particular price level. So, but for this particular strategy, the EMAs that I employ I'm going to load them up here. Okay, and I'm just going to tell you what I see or how I see whatever I see using them. Okay, so
Yeah.
the
Can have you started presenting your screen at all?
yeah, oh,
Because I
sorry,
can't
you can't
see
see
it.
my screen. All right, let me.
No.
So now my screen is on. So the first of them is 633 EMA. All right, I'll be able to tell you why 633 and what I use it for. Okay, and you'll be able to
Yeah.
see that in history. The 633 EMA, instead of me having probably another indicator at the bottom, all right, I use the 633 EMA to show me an oversold or overbought region. All right. So when the currency is gravitating towards the 633 EMA on any time frame, I will be looking at that area as an area whereby if the price is coming from the downside, I will be looking at that area as an area where price is likely going to be overbought, right? And the next EMA that I employ is the 200 EMA. The 200 EMA is used by majority of traders to know where the bears and the bulls are using as a territory for their position, such as when the price is hitting the 200 EMA, if the price is coming from the downside, or the bears, say for example, the trend has been down, the bears will come in to come and defend that they are downtrend or that they are down position. So they use the 200 EMA to note areas of averages that would determine um, where they should be acting. So in this case, you can see that the price came down from the 200 EMA. Does it mean that the 200 EMA cannot be broken, or any of this EMA cannot be broken? Of course, it can be broken, such that when the takeover is taking place, then obviously, or if the trend is changing from an uptrend to a downtrend, those EMAs are literally going to be broken. So the first one that we look at is the longer term one that will signal when a move is going into an overbought or oversold territory. Depends on where the price is coming from. So if the price is coming from the downside and the trend has been down, right, the 633 EMA will be on top of the price. All right. So this can let you note what the main or the major or the longer term trend is, especially depends on whatever time frame that you are using it on. But I like to use it on weekly to show me the near time change of direction as well, and it tends to work very well. So the 200 EMA, when these bears, when they take advantage of price and price is moving down, the 200 EMA is literally going to be acting as a barrier that they're going to be watching to either continue their downtrend or come in to defend their position. They would use that as an area where they want to add in more position to their position. Does it mean that it cannot be broken? Of course, it can be broken, as you can see it over here. And then, such that when it's broken and then the price now starts to move above it and start to retrace back onto it and use it as a support, then that will identify that new trend is in place and new players are coming in to take advantage of the price away from the previous one. And you can see the struggle that initially what tends to happen is when we have this downward pressure, which is during the significant recession at that particular point in time, price tends to gravitate back towards the 200 EMA to confirm whether the whether the bears are still much more interested in their position. But that's one key thing. But the other key thing is which you need to note ahead before time to understand whether this 200 EMA will be able to hold or won't be able to hold was how price is developing. You can see that when we hit that last low, right, we have an excess low, which was part of the thing that I was discussing with you guys yesterday. Right, so the excess low will come in to come and signify to us whether we've attained the lowest low such that price can change. But yeah, the bears, they won't just give up easily. They will be coming in each and every time to come and defend, coming each and every time to come and defend, coming each and every time to come and defend, you know, till the last of their orders, sell orders, is not going to be in the market anymore, and they're going to lose grip of the market temporarily. Let's say
Can I quickly cut you? I'm sorry.
yeah, go on.
Before you go further, I was just thinking, what message would this be passing on if you see the price moving towards the 200 EMA and you're in that trade? What would be your reaction if
All
you
right.
see price moving towards 200 EMA? What message would that be saying to me as a trader?
All right, so the message that you want to be looking at is how did we come down from 200 EMA first of all? So we came down like this, right? And then we move up, okay? But everything that happens there, trend hasn't changed. We move up, okay? At some point in time, we come down to this low, okay? When we come down to this low now, one thing that you can see is this is the last reference low for now, okay? And then this low now should continue to be going down for the trend to remain what? To remain to the downside. But for one reason or the other, this weekly candle shows us that, well, anyway, we have reached the best part of the low that we need to reach. Now we are changing direction, okay? So when we are changing direction, what that is telling us is the short-term trend to intermediate trend has changed, okay? The longer-term trend still remains the same, right? But now, because of this long period of, let me see, because of this long period, which started a little bit from earlier, of decline in price that we've seen, right? This long trend, this long period of decline in price is not just going to transform immediately and change the longer term trend back to the up direction, okay? But we can be seeing some intermediate trend, okay? We can be seeing some intermediate trend change that will occur in price, all right? Such that when price now starts to gravitate towards the 200 EMA, those intermediate trends will now be in check, all right? But one thing that I want you to notice, once we have this low, and then we have this higher low that comes in with excess, first of all, it kind of shows us that the aggressive traders comes into the market, all right? And the aggressive trader who comes into the market are the buyers. But the bears, right, who are in control before now, the bears will end up wanting to still stay in control, all right? Which means when they reach the area of 200 EMA, that's the time whereby they want to start looking to defend their position again. They are more than happy to take some profits in all this area and then want to come back in, right? To come and continue the downtrend, okay? So that each and every time, what you will be noticing is when you take a trade against that 200 EMA, you will have a low risk. But the continuation to continue to the downside, well, can be in check. Depends on how this move to the upside started, all right? So what I wanted to say to you in essence is this. Say, for example, we have this down move, all right? And then we do not have a failure that's showing us that we have now exhausted going down, which is this lower, sorry, which is this higher low in this case. And price comes to 200 EMA straightforward, okay? Then the trend has more chances of continuing to the downside. Do you understand that?
Yeah.
So, but if we have a reason that's showing us that, okay, we are losing the longer term momentum of that move down, right? And then we can see that in form of the weekly higher low, which is the one that's present over here. Then we know that we're going to be careful that we might not come back to test this low immediately. And we know that even when trade comes down there, right, we can still be seeing some shots coming in, right? It's now depend on us to be monitoring for continuation. And how do you monitor for continuation? You can see that every sell-off that comes in at the back of this 200 EMA, at the back of the 200 EMA, right? Every sell-off that comes in at the back of the 200 EMA, none of them was able to give us a continuation even to this low, right? But does it mean that you shouldn't still believe that the longer term sellers are the one coming in there? Obviously, you still have to believe it because the price is moving down and we're still respecting the 200 EMA. Until we stop respecting that, right? Whereby price move above the 200 EMA and start to use the 200 EMA for some kind of support, that is the time where the longer term trend, which is the longer term downtrend, would have now changed and start looking towards the upside. All right. And if you remember what I said, when that longer term buy starts to look to upside, the 633 EMA will always be there at a point in time to show you that we have overextended. So the oversold region of the 633 EMA can see now pressure price down and still use the 200 EMA for a support for price to continue to go back up. But in the events whereby we break the 200 EMA, that is the change of direction again. And then these old shots that we've seen in the market, if you remember the lesson about pattern, can then continue. So you're going to be using the EMA in combination to whatever you've learned before. You cannot just use it, but it will be giving you a clear direction of, okay, who is still in control? Is it a short-term trend that I'm seeing, such that when price starts to go up in this manner, you know that that's the short-term or intermediate buy trend that's occurring, because we are still below the 200 EMA. But the moment we go above it, now we know that we can start to look at things towards the upside. But if you still remember quite fully well, your training on patterns, all right, that is giving you a clear perspective in a different manner as to what happened over here, right? Which second. This populate a little bit. So what the pattern is telling us is there was a big pattern over here. I got disappointed when we had this break, okay? This impulsive move still remains as an impulsive move. You can't forget that, all right? Although price can never stay down forever. Price will need to definitely move back up. And when that is happening, it's just because we may have gone too short for one particular period of time, so fast, so quick, such that price needs to go back up to find some more new buyers, some more new sellers in this direction. With this pair, some more new sellers that will be able to now give us that continuation. So, because you can see that we have this pattern, then we have an impulsive move out of this pattern, and every single thing that happens over here, right, still remain a corrective move. So you still want to remember that idea at the back of your market, such that when this corrective move now breaks out of this pattern, you can then have the impulse, the correction, continuation that you are looking for. So the behavior of the EMAs in a correction, right, is completely different to the behavior of the EMA when we are in a trending market. When we are in a correction, the EMA will tend to be overlapping one another like this, okay? when the trend is very strong, the EMA will open wide, which means, and I haven't gone there. So what I'm trying to say to you now is for you to note correction after you've understood what the longer term trend is based on this 633 and the 200 EMA. Now the 12 EMA, which is the blue one, and the 36 EMA, they perform a different function. The function of the 12 EMA is to understand volatility. How strong is the move going down? The 12 EMA is just a 12 period. So this is just measuring 12 period, 12 trading days or 12 trading weeks, or just measuring 12 trading 30 minutes chart, or 12 trading, or 12 prices away on a 30-minute chart, or 12 prices away on a 1-hour chart, and so on. So what the 12 EMA is doing is the 12 EMA in some cases, right, can act as a temporary trend line, okay? And I'll demonstrate that for you to see if we are in a trending market. If we are not in a trending market, the 12 EMA and the 36 EMA, they will be crossing each other, they will be overlapping each other. And even to a point whereby when we move down to a smaller time frame now, you'll be able to see a place on the chart called Volatility Squeeze, whereby all the 12 EMA, the 36 EMA, the 200 EMA, and the 633 EMA, all of them will come together in a particular region. I will show you that one. But first of all, let's talk about the 12 EMA now. So if you're noting, we've discussed the function of the 633 EMA. Let me, for the people who just joined, let me just write a note so that they can understand where we are coming from before I go in depth. All right. So the 633 EMA acts as a region of overbought, sold region. Okay. Just simply as that for beginners. The 200 EMA is a region in this case, the bulls, which are the buyers, or the bears, and the bears to, that's a region where the two opposing market participants use dividing. So, in other words, for you to buy the what's it called? For you to buy the cheapest price when a trend has begun and continue with the the trend, what you will be doing is you'll be finding yourself in a position such that if the price comes down to the 200 EMA, then you are looking at that as a very good area for you to literally take a position. All right, so that is the application of the 200 EMA, and I'll demonstrate that for you on smaller time frame as well. But obviously, you need to know when changes is occurring, so that when price gets here, you want to take a low risk trade in this particular area. Again, sorry. You want to take a low risk trade in this particular area for price to continue to the upside. But just as I've said, right, when you understand pattern, which is one of the first video that I did in this COVID-19 series, you will know that when a structure such as this, right, is invalidated, irrespective of whether there's an EMA there or there's no EMA there, just because that structure is invalidated, whatever the EMA does there will not be respected. So when I begin this class, I said to you that, does it mean that the EMA cannot be broken? Of course it can be broken. So when you are tallying your knowledge of the market structure or the structural patterns that you are seeing in the market, when you are tallying it together, then you can easily anticipate whether that EMA can be broken or not. All right, but I know that may be much of a job for beginners or for new traders to be able to understand. In this situation, we have a pattern over here separately, okay? If this pattern is going to break, all right, the first thing that you're going to see when this pattern is, if this pattern is going to break, is to see that the pattern is going to give you an impulsive move towards the area where it's going to break, okay? Such that that impulsive move can be a strength to capitalize on the bottom of the channel to break that particular channel. All right. So pattern and understanding pattern is key at the same time, even if you want to employ your EMA, because if you see that an impulsive move is coming down, or if you've noticed that we've got an impulsive move down here, right, and break this internal ascending channel such that this is a correction. You can identify that this is a correction, or whatever is happening inside there is a correction. Then you know that the continuation will now possibly follow, and that continuation will come through the pattern, and then we have an impact, a strong impact to be able to break the longer term 12 EMA. But had it been this chart give us more data, you will be able to see how the buyers, which are the bulls, are defending their position each and every time when we come to the 200 EMA. And you can see that in this case, this, how do I call it? When the price comes down to the bottom of the pattern over here, despite the fact that we come down impulsively, yeah, in some certain manner, we still have some kind of balance that's setting first of all, right? And balance, as I've shown you, is alerting us to when the market settles and market has accepted that price. And then the one thing that can happen in balance is price can break balance to the downside, or price can break balance back up to the upside. So you want to be careful. If you start to see that the market is creating a doji, it's telling you that the market is taking a breather, and then possibly we might not be able to break. But if we start to come down impulsively, such that the following day now follows impulsively as well, right, and break conveniently very well, then you know that that 200 EMA position that you want to buy, you don't want to be part of a long trade anymore, because this does not only invalidate the 200 EMA, it invalidates the pattern as well. So when you look at this pattern and you see that this pattern is breaking, and it's not just only breaking, it's breaking the 200 EMA, easily you can easily be able to tell that directional shift has occurred. Now some new traders or some new opposing force has now taken over the market. So back to the 12 EMA that I'm discussing. The 12 EMA serve as a measure of volatility, all right? All right, so I lost you guys for some moment over there. I think it's my connection over here, right? Measure of volatility in a trending market. And what I mean by that is in as much as the trend remains to one particular direction, all right, the 12 EMA, you can use it as a trend line, okay? It can serve as a trend line to measure how strong the price is, okay? The price will be gravitating back towards the 12 EMA and then be using just the 12 EMA as a position or as an area to bounce, or in the way that the price use the trend line in a trending market. Like I said, the way that the price use the trend line. Okay. Can you hear me? Are you there?
Yes.
All right. So
Yes.
the price can be using the 12 EMA as a as a as a trend guidance. All right. So and going forward, the 36 EMA in this case now, which is the orange one, okay. If the price is very strong, one thing that you're going to understand is this: the price will be finding it difficult to move or to trade below the 12 EMA. Okay, hold on a second. So sorry about that. As I was saying, but when the price breaks the 12 EMA, right? Then the first key thing that you're going to be alerted to is the volatility uh, is now losing strength. Okay, but we use the 12 the 36 EMA now as a guidance to look for whether we can find a retracement. Okay, such that 36 EMA will now be doing a function of the area whereby we're going to be looking for retracement to before we continue to be going in the actual direction where the trend was before. All right. So that is the function of the 36 EMA, and I'll be able to demonstrate that for you. So does it mean that all these key EMAs cannot be broken? Of course, they can be broken. Everything depends on what kind of knowledge do you have at the back of trading the market. As much as there can be some short-term guidance for you, right, you still need to be aware to when the condition is changing, because what the EMA actually does is the EMA measures strength. Okay, it can only measure the trend. For you to know when the trend is changing, you have to employ multiple EMAs to be able to detect that. Okay. And what do we use the, 1 second. So let me write a function of the 36 EMA for you. Okay. So now you have the major functions of those EMA. So in this case, what you're looking for is the 36 EMA we come in somewhere around there, and then the buyers will come in to defend the position and start to take the price back up. As soon as that is not happening, then you can easily use the EMA to denote change that, oh, okay, this trend that I see going up, going up, going up for some time now is more or less like that trend is losing steam, right? And then obviously I cannot add to my position anymore except when I get to the 200 EMA as well. And the one other thing that's important again is when the 12 EMA tends to cross the 36 EMA, okay, and it's alerting you to change of direction. It's alerting you to change of direction. All right. So when you have the 12 EMA and 36 EMA cross in a trending market, market condition goes a long way in this situation. In a trending market, EMA 36 EMA signifies direction. Okay, and so all this little intro that we've learned, it's now time to put it to use. So say for example, when you look at the current position of the pound dollar, right? And we are looking at a much longer term over here, right? And when I mean a much longer term, I'm talking about because we are on a weekly chart, all right? And being on a weekly chart, we are not just hold on a second, please. Right, so sorry about that. Going forward, when you look at the where we are currently, okay, so we can see the strength of the sellers coming into the market, pushing price down. All right. The one key thing that you note is we've had a cross down of the 12 EMA, right? And obviously, when the 12 EMA is staying below the 36 EMA, the sellers are in control, right? When they are overlapping each other, you know that we are in some kind of correction. When they open wide again, right, then you know that, okay, the trend is continuing, the trend is healthy. Over here, we are seeing some funny fake crosses, which one needs to be aware of. So over here now, what we've seen is, and you can see how who are coming in each and every time that we get to this area is becoming very important for us to be watchful of what is likely going to happen. Yeah, it doesn't necessarily matter that if we have a 1 week close, it does not mean that the trend has equally changed. Sometimes you can have a situation like this that will form that double top, and then the situation will change. You still know that you are around the area where um, those longer term traders can come in to defend their position. Okay, so in this case, luckily enough, the price shoots up to the 200 EMA. Does it mean that the trend has changed? Obviously, the trend hasn't changed. You can see that the 12 EMA has been the guidance of the bears all along, such that when we hit this longer term low, okay, what we realized is we saw some influx of buyers at the low. These buyers are opportunistic buyers taking advantage of low prices, all right? And they push price up, and where they're getting to now is that 36 CMA. All right, so this is the area whereby we now need to be careful to be a buyer, because at 36 CMA, we can find sellers rushing back in to change direction. And the funny thing is this: when you look at 2 weeks ago, 3 weeks ago, the candle that we can see on that 3 weeks ago signifies that we've hit an eye, all right? Such that we now have that sell-off coming in. Everything that's happening over here is making of decision to know which direction we want to go. Obviously, they know that we are in a territory where the sellers can easily come in and defend their position. The buyers are not showing enough strength to push price up higher. All right. The sellers are trying to make decision to push price down, but equally you can see that there's no much of momentum around this area, like in this case, that breaks the price up higher. So you want to be careful around this area to know that easily, just because the longer term trend is down, okay, we can find some significant move back down to the downside if the sellers decide to come in. So that's what the sellers are waiting for, to gather up more momentum and see whether price can go down. So, but as we can see, the first thing that you notice, the 12 EMA has crossed down below the 36. If you go to the daily now, just like what I was discussing yesterday, you'll be able to note whether we have change coming in or whether we have some funny thing going on. All right. So when you look at the daily, one thing you can recognize is the 12 EMA and the 36 EMA. They are so close to each other. All right. So in this scenario, the price is definitely in a range. Okay. And then what do we have up here on the daily? All right. We have the 200 EMA, and that 200 EMA will be showing you equally that the sellers can come in this area to come and defend their position. People who trade support and resistance as well, they will be looking at this area, right, as area of confluence. So you can be seeing a couple of confluences. There's a support over here. There's 200 EMA over there. So easily you can know that there can be struggle. The price is not just going to move quicker up higher. This struggle can literally change direction. So if we look at previous, if we back test what I'm trying to tell you on 12 EMA and 36 EMA, let's have a look at it over here. When the price sells off, the price come back down to the 36 EMA as a retracement to make a major move down back again. And when the price try to retrace back up again, the 36 EMA is holding the price as magnet to come down again. And one thing you have to understand is this: when you start to see this reaction, you see that we have the bull pushing the price up. You see that we have the bears pushing the price down, bulls pushing the price up, bears pushing the price down. That is an easy identification for you to know that the buyers and the sellers, right, they are in a huge tug of war. All right. So when you start to see move like this on a chart, what you want to wait for is which area are we going to break out to. So when you have 36 EMA guiding you, and then you are looking at the direction of the trend, you know that the move is equally, can be equally be stronger to the downside. So this over here, the buyers and the sellers tug of war, that you can see the same, almost the same thing over here as well. These are little candlestick patterns that you can add to your trading technique to let you identify what is going on in the market at a particular point in time. So notes, go on, question.
We refer to that also as, can we refer to those candles as well as order blocks? Are they order blocks?
Right. So if you're going to be looking at order blocks, the key characteristics of order block is you want to see one candle which is coming in one opposing direction, and then you want to see a next candle that literally this can be a bearish engulfing candle, right? In this case, a bearish engulfing candle that takes over that direction away from the previous direction. So in this case, we didn't see much of a bearish or a very strong bearish engulfing candle, right? But yeah, over there are challenges to the orders around there. Okay, so if you want to refer to it as order block, majority of the people that trade other blocks look at it in terms of, okay, there is bearish engulfing candle over here, right? And before that bearish engulfing candle, there's a bullish candle over there. Majorly what they trade is just the candlestick, and then what they are looking for is if price comes back down to that area, all right, because of the presence of that order block, then that's when they want to use it as an advantage to take a short. All right, I don't know if the difference is clear. So they are always looking at, oh, this area has formed. All right, when price comes back down to that area, okay, there's another block over there, and take advantage of it. And it's more or less like a demand and supply zone as well. In this case, it's going to be a supply zone. So majority of the things are the same concept. Some people just come in to explain it in different terms, you know, like even the language of the Bible is not, at the point in time in the Bible, they said when God wanted to give human being confusion, he started giving them different type of a language, you know. So those are the same languages, but in a different presentation. All right, but depends on the kind of trading strategies that you are looking at. That will be the name that you're going to be giving them at that particular point in time. So we can easily say that, okay, probably because of this other block over here, this is a bearish engulfing candle, although it's not as big as this bearish engulfing candle. But I mean, in that area, we can say that possibly that other block, if that's what you're looking at, will be the one that has been ruling over here up to this area as well. All right, so order block. And order block at the same time as well, look at this candle. At a particular point in time, that same area of order block, and that's why you have to be careful. That same area of order block gets what? Get breached by a significant bullish engulfing candle. And the only way that you can see this one coming might not necessarily be, probably you can look at this and say there's another block over here. All right. And this bullish engulfing candle is what is signifying that there's another block over here. All right. So that is the way the order blocks looks like when you are identifying it. But with this one now, this is an excess right here. This is significant aggression. Other blocks have to take into consideration two different periods. Okay, when it comes to excess, is looking at just one single period, one single. The other block, you need maybe about 1-2 days, which means the first day of the green candle or the first hour of the green candle, and then the second hour of the bearish engulfing one. Then obviously you can use that as a confirmation to start selling. When price comes back down to that area again, then it can be another good area to sell. But the more the place is being tested, the weaker the other blocks over there becomes. You get where I'm coming from? The more the place is being tested, so we got to test it again the second time over here, and then we see the sell-off. We come around all over here to test it, then we see the sell-off. All we are saying in this particular scenario is the sellers are taking advantage of this significant area to make a buy and sell, or the sellers are taking advantage of this significant area to make a sell decision, you know, such that when they sell off this time around, the magnitude of the selling off cannot be compared to the magnitude of the selling off of the of the first move. So what will be key for people who trade order block is to be able to identify risk and then know that the risk over here is about 69 pips, and or yeah, you can add maybe about another 10 pips to that, making it about 70, making it about 79 pips or so in this area, and then that would be the risk, and then they want to make sure that at least the trade gives a reasonable risk and reward going forward. But what happened over here is completely different. Over here now, you can see the cross of that EMA, right? And then when the blue cross above the 36 EMA, that is signifying possible change coming into the market, okay? So that when we are going to attract the other block that are over here, we have an indication of a change coming in first of all. So that indication of a change may not make the move that is going to be present in this other block region to be as strong as the first one. When you look at here, you can see how wide. Can you see when we add the cross, okay? From when we add the cross, right, for the EMA traders or for people who love to trade EMA, you can see that we continue to have a widening gap between the 36 EMA and the 12 EMA. In this place, the cross did not come in, although price traded above the 36 EMA and the 200 EMA for one reason or the other, which is not for today to explain. But what I want you to pay attention to is after the cross, right? Some people are looking for areas to scale in back into position. Okay, so say for example, when this cross happened over here, okay, the key thing is you need to be able to identify direction, either a long-term or a short-term direction, right? And then when the cross happens, then you want to follow it in the direction of the trend, all right? So look at over here. We didn't have the 12 EMA, 36 EMA cross, okay? You won't be able to see the prices over here before, but just because we didn't have that cross, all the move that goes above here turns to be more or less like a fake out, all right? Price comes all the way down. The next best place to have had position would have been near that 36 EMA. All right, so that when price comes over here, price didn't touch the 36 EMA, although we encounter a sell-off, right? But we still come back to come and look for that 36 EMA, and then that's when the real trade actually manifests, such that the people who take this trade, right, at the back of nothing guiding them, when this trade occurs, when this move occur, majority of them may have been taken out of position, okay? Just because price managed to go above here on this particular candle, create that fake out, and then the selling continues. But the key is there's a wide gap between the 12 EMA and the 36 EMA. So you still know that despite the fact that price is pushing higher, all we are looking for is we are looking for more significant sellers that's going to come into the market and push the price down. Over here, the condition has slightly changed. All right. Even when we get to the area of the other block, there's still some trade that materializes. Okay. And then we have the price, the 12 EMA crossing down and immediately cross back up again. In this scenario, when you see that too sharp cross and then that is backing it up with a big candle like that, you know that that is temporarily direction change, and then we start to have a widening gap between 12 EMA and 36. That shows you the strength of the buyer still remains in the market. So if we look at where we are currently, you can see that the strength of the sellers who push this price down, okay, the strength of the sellers who push this price down started from when we had this cross, and then we've never seen any cross back up again, such that even this move, you can be able to recognize some moves that are likely going to be fake out, right, when the cross has not even actually happened. All right, so price continues to go down and go down. We come back to the 36 EMA, we use it as an area to take a short, but that short did not manifest itself properly. But as you can see, the area of 36 EMA can be that area that is so magnetic to price for price to change direction temporarily. How far is going to work out, then that's another issue. And that's the reason why at the back of some trading strategy, once you take your position and you hit your position, you try your best to do what? To secure some profits, okay? Or if you are not securing profit, you try your best to put your trade to break even. Because over here, it would have been evident to you that this place might not really work out because of where we are coming from, okay? And then we approach this place impulsively, patterns again, such that now we now seeing some correction that will lead to continuation. So all these things work hand in hand. Sometimes for you to be able to put everything together might be so challenging, but you need to start from one basic thing, okay? Once you understand the basic thing, then it's going to be easier for you when you start to see things occurring like this. Then you go, well, there's an impulsive move over here. If this sell-off did not continue, right, we are coming from an area of a longer term reference, all right? And when you are coming from area of a longer term reference, one thing you have to understand is a law of orders are going to come in if that area fails, right? A lot of orders are going to come in if that area fails, and you can see the impact in the force of the orders that comes in. This area managed to fail, and the impact in the orders that come in make sure that the 36 EMA cannot really hold the price. So on the pound dollar rubber, now we are in a significant area. If I am anyone, one thing that I will know is once we are in a significant area, and I know that price is not just going to sell off like the position over here, you can see the widening gap between the 12 EMA and the 36 EMA. Over here, do we have that gap? So we do not have that gap. In fact, it's looking like as if the candle, the chart is going to, the 12 EMA is going to break up to the upside, and we can continue to see higher prices. But the key thing again is the largest, one of the largest P that I secure in my trading career was a 3,000 pips trade, all right? And the way that I took that trade was from the cross that I saw on the weekly, right? To change direction, because some of the things, when the cross occur, especially when the 12 EMA cross above the 36 EMA to the upside, or cross above the 36 EMA to the downside on the longer time frame, okay, you tend to see some serious, you might find yourself in a lucky position to see some serious move to the upside. In this case, this is about 1,500 pips. That trade that I was talking about was a euro yen trade, all right? And the only thing that I did was I noticed the cross on the weekly chart, 12 EMA and the 36 EMA cross, all right? And I take advantage of that scenario. So in this case now, you can see that the pressure on the weekly for the longer term trade is still looking to the downside. We haven't actually seen a confirmation that the buyers have now significantly come in such that they can change direction on weekly, if you are still following. So let's look at the daily. Then I want to show you some other things on the smaller time frame as well. So we've talked about this daily. This is acting as a barrier. You have that area over there acting as a barrier. So what you want to be looking at is before the market opens, when we are getting to this area, because we've tested it the first time, we've come to test it again the second time. You know, more than anything else, you want to be taking your trade as close as possible to the eye, which you've identified way earlier before time. So the trade that you're going to be looking at over here would have been possibly a short trade, but in this case, just because of the way the EMAs are, you are being alerted to the condition that's telling you that we are doing what? We are consolidating. In fact, more or less like we are in a box. We are consolidating. The range of this box is about 400 and something pips. So you are better off from the high of the box to the low of the box. That would have been the best trade until a decision is made around this area. But if we look at the 4-hour time frame, So the magnitude of the trade that occurs on each time frame depends on the time frame itself. So someone that's not trading for longer time is okay with the 4-hour time frame. See the cross on the 4-hour time frame, we'll be happy to say to his or herself that, okay, let's look at it in this case. 4-hour time, just for confirmation. Some people like to look for confirmation. Some of us like to understand where the reference point is and take advantage of the reference point. So if you're looking for confirmation, the price would have moved way lots more than someone who understands reference points and wants to take advantage of the reference point. So the cross has already occurred. All right, it's looking like as if the gap is widening. Trade is coming back to 36 EMA, and then that's when some people are going to be looking for a buy opportunity. But the challenge over here, you can see how the 200 EMA is working against the trend direction. And if you remember what I said down here, the same thing that we saw on that weekly chart, and that's the reason why I like to do the trading of EMA on most of the time frame. When you see that the price comes down, make that low, right? Despite the fact that you should be understanding that there's a reference point over here, that longer term reference, if you remember, okay? And then we make a high over there, and then we come down. This is a failure, right? To continue to the low, right? On the longer this low that we've seen at the back of this huge reference point. Sometimes you need to actually see the action such that we make a new high again, and then look at what we've done. We now come to understand, to find rejection at the back of that key reference point. That key reference point, I'll show you where we find it again on the weekly for some people who are not there when we locate it. Is this low right here, this last low that we've seen, that significant low. That's where we find this blue purple line, blue tail line, okay? And that's where we find this blue tail line, and price comes back to it on this particular red candle and form a huge wick. Sorry about that. Right, so when we go back to the 4-hour now, same concept works on all time frame. We made a low over here, we made a higher low over here. That is alerting us to the fact that these traders that make this low, right, on the 4-hour time frame now, they do not have enough strength to continue anymore, okay? This move over here at the back of a huge longer term low, right, is very significant. This move over here is an identification of understanding the failure to continue to go in the direction of the longer term down auction, okay? So that failure that failure right there is giving us a sense of understanding that we know that the longer term reference is there. All right, the exact value of that longer term reference, let's see. That's my magnetic tool. So it's 1653. 1650 level. All right. That is a key level which you will remember for the rest of your trading career whenever the price comes back down there again. So back to 4-hour chart. The failure of it was this area. The key thing is, would you be able to visualize the move up before the move actually occur? All right, such that when we're getting over here, what do you think will be happening? When we're getting to this 200 EMA, what do you think will be happening?
Rejection.
All right, so that rejection occurred the first time, the second time, the third time. all right? And it's all because of all these bear trying to come in again to come and show their strength that, yeah, we know that you are coming back to our territory. This is the best opportunity for us to take a trade. Some people can take a trade over here and even make millions because they know they will be present over there. And those are the key to understanding different type of strategy. You know, you might be looking for a trading opportunity and you know there's a definite opportunity over here. They are not looking for 3,000 pips. All right. I'm not saying it's not good to look for 3,000 pips, but what they are looking for is that area of certainty. Okay. And they know that that area of certainty at least generated 75 pips. That area of certainty, let me see, still come down to give them almost about 180 something pips. Okay. And they have that position in the market and they know that because of that area of certainty, at least they will be able to make some pips in the market. We can put a huge amount of money at the back of the 200 EMA, you know, and still make profit. They are not looking for that huge flush down just because they identify that we have a market failure low over here, but they know they're gonna come in to come and defend their position. So that comes in again. So when you start to look at it, you can see the gradient, the lowest low, right? The first higher low, the second higher low, and then we have the third higher low over here, right? And then we have a push up higher. Even when you start to look at this low now, this is looking like the fifth higher low. So when you are looking at this trend as a whole, there's one thing that the low continues to tell you. The low continues to show us the sellers are failing. Okay, the sellers are failing to make a new low for now. All right, so the buyers are still managing to take advantage of the market. Although when we get to what happened to 603 EMA,
It's overbought there.
right? So
Sign
when we
of
get exactly on the longer time frame, another sign of overbought, the push start to come down. All right. So if this push we now, and this is the key thing. This is the reason why I look at various way of looking at the market, so that I just don't cloud myself in just thinking about it or looking at it in one particular direction. I was looking at this chart and I think, was it the same chart? Yeah, I was looking at this chart. I was putting structure at the back of it. Looking at this structure, okay? And then I was looking at this structure such that I know for a fact that if we come back down to this area, if we find rejection, we can still push back up higher. All right. So the EMA is giving me this area, but the funniest part of everything is I don't want to consider this area now. The reason why I'm not going to be considering this area now is I'm looking at this area as double top. Okay. When I'm looking at this area as double top, I will be placing majority of my trade to buy again at this low if price gets there. All right. So say for example, I want to buy one standard lot. I can say to myself from here to here, from this area where we are now to here, that's about 140 or 150 pips. Okay. If I don't want my trading risk to be 150 pips, or let's say I'm not even going to be the way that I will look at it is from here to here, is this is not going to be my stop. I'll be looking at this area as area of stop. In worst possible scenario, I'll be looking at this area as area of mental stop. So that's 342 pips. If I know that my trading account that I'm trading at that particular point in time we'll be able to abort 342 pips, say for example, and this is what you can do. Let's say baby pips. So let's see it again. Where's that chart? So babypage.com, then I'll go to tools, go to position size calculator, then say for example the trading account is $2,000. Let's look at someone with a small account of $500. Okay, the risk percentage is not supposed to be more than 2% on that one single position. I'm looking at 342 pips or 350 pips. Okay, and the currency that I'm looking at is pound dollar. All right, current price of pound dollar time 124.95. Right, and then I do a calculation at the back of it. All right, so I can see that I can take a position of about 0.03. All right, the only broker that allow this kind of position is, and the amount of risk is £10, is Oanda. Right? Oanda allows this 357 unit size position. Okay, so my consideration is I've learned something, and what I've learned is I'm looking at price to possibly reject somewhere over here to go back up higher. All right, but like I said, I personally, with my experience, I wouldn't really want to take a trade in this area, because if I take a trade in this area, that is what is going to be the risk, which means whatever position that I take in this area have to be a small position, and then I have to be able to withstand that price is not going to come down to all this area, right? So if I cannot withstand that, then it's up to me now to start looking at another form of pattern separation. And look at this as this. There's the pattern over there. There's this pattern over there, which can equally work. When you separate one pattern inside another pattern, all right, you can then find out, okay, then that means if that price comes down to this area and we find rejection, then most probably my stop can be around this area. But if I do not see anything in terms of structure like this, right, that can give me a little bit of confidence, because this is a structure that needs to be broken. This structure needs to be broken before we get to this structure, right? And this structure needs to be broken before we get to my stop. And this stop needs to be broken before we get to my main stop, which is supposed to be down there. All right. So one key thing is now for me to wait and trade structurally and see whether price is going to come down there. If price comes down there and we find rejection, then I will be able to say at the back of my trading decision, taking that trade according to this particular pattern. And this pattern now will be the reason for me to have a much more lesser stop loss. But if I do not see any pattern in this place like this, right? And this pattern is alerting me to look at this. This is high, this is lower low, this is higher high, this is lower low, this is another higher high. So if we still come down to all this area, we still forming a lower low, and then this pattern can still form in terms of, can still give me an opportunity to look at the price in this form. So the trend is still intact if it continues to go like this. right? But the moment if I can't see this pattern for any reason, if my eyes is not sharp enough to see this pattern for any reason, okay, then I don't have a choice. This is going to be area of my low. This is going to be area of my stop. But if I can see this pattern, I can minimize my stop. But I want to see the reaction that's going to happen around there, first of all, before I take that trade to the upside. All right. So now you are not just employing the EMA alone. Now you are making your trading sense to become much more robust. But how many people will be able to withstand so much of an information? That is another key thing. That's why trading and trading lessons have got hierarchies and have got classes. If I come up with certain things and teach you in one way or the other, it might complicate what you've already known that you are trying on. All right. But when you can add everything together, then you will become a much more robust trader. You will always know the reason why you are looking at something the way that you are looking at it, if that is making sense. So on that 4 hour now, that position of the 633 is what is ruling, and that ruling, right, just because we've been there before, we encountered this huge sell-off, the whole of this, because this high, we do not make a new high, right? Although we break the 633 way better than the high over here, but we do not make a new high. This high is even a little bit lower, right? If we check it, and I look at price to that point as well, you look at here, the high of this price is 126.47. All right, the high of this price is 126.43. Okay, so if we are strong, right, this indication that I can see at the high, most probably we will still be able to trade at least a little bit way higher up than 126, 120, 126 47. Even if we trade 126.50, okay, then I'll be looking at it and be like, okay, most probably we can still continue to go up. But that weakness, failure for us to be able to have another higher bid than the previous one, is bringing in some kind of weakness at the back of this price, and I can see possibility of this move declining down into all this area, make a decision over here whether I want to go up or down, right, and then possibly come back down to this area. So this will now be determining the kind of patience that you need to have at the back of your mind, that okay, I'm not going to take any trade over here, let me see what's going to happen over here, right? If in fact, if we come down to this area, just because this structure is there, then I can be looking for opportunity to do what? I can be looking for opportunity to buy up again. And so I will filter my trade. That's just a filtering process for me, the way that we make the ad. So, and I know that there's a 633 EMA over here. All right. So that is that on the 4 hour time frame. But the key trade that you will see on this 4 hour time frame is price coming back down to this 36 EMA, right? We struggle to have a cross down. All right. So at the back of the 36 EMA, there can be a possible trade over there. The only challenge that you have is the 200 EMA is very close. Okay, so when you are looking at retracements, you want to be looking at your retracement in a trending market rather than a market that is closer to where a squeeze can occur. I will show you an example of this volatility squeeze that I'm talking about. Most probably we can get it on it's always there on a much more smaller time frame, even like on a 5-minute time frame. I will show you what a volatility squeeze look like when we have all this EMA combined together almost in one region. Okay, what you're going to be looking for in that area will be some kind of a breakout. Okay, and when you see that breakout can give you a very strong continuation. But that volatility squeeze always occur the most on on 5 minutes time frame. On a 5 minute time frame, you can take you can just be scrolling. You know, sometimes your brain don't want to analyze much of the charts, and this is the honest truth. And you need something visual to be able to help you out. Okay, so you need to start understanding some silly little strategies that can produce some gigantic results. So when you look at this 1 hour trade, let's look at the 1 hour trade. What is happening at the back of the 1 hour so that you can understand. If you remember, us discussing this low at the back of that occurs after this reference low, okay? The first move to 36 EMA was what gave us that last low, okay? That's when the last short comes into the market, because what tends to happen is this: traders tend to have some behavior. When something is working, they will continue to follow that thing that's working until it stops to work. No more. Since the fall or the decline of price from the high prices and the crossover, the first retracement comes to the 1 hour 36 EMA. Look at this. This is the volatility squeeze I'm talking about. When a massive big directional change will occur, all those EMA, they will be occurring together in one particular place. Okay. And then a breakout is tend to happen in that area. So note this strategy. That's exactly a volatility squeeze over there. Every time frame. All right. And what does that mean? What it means at that particular point in time is this. You remember, moving average is average of price. All right. So the 36 EMA, 36 price back, right? Average combines over here. 633 price back, average combines over there. 200 prices back converge over there. All right. So it's more or less like there's a very significant cheap value in this area. Okay. And in that area, a decision will need to be made, whether anybody likes it or not, because you don't usually get this. You don't usually get all the EMAs combined together. All right. So for future, this volatility squeeze works, and I was even looking for it on a much more smaller time frame to be able to show you, but at least now you can see it over here when that convergence comes together. So, and this is what I'm talking about, that sometimes you may just be tired, you don't want to do any analysis, but when you know the key things that you are looking for, like convergence of all the EMAs, you can scroll through 50 charts and just be looking for this strategy alone. You are not drawing anything, you are not doing much of anything. Then when you now spot it on one particular chart or two particular charts, then you know to yourself that, okay, now I have something that I want to play with that I can narrow down, because this is more or less like, you know, like the way the scientists will talk about the solar eclipse or the moon eclipse. It doesn't usually happen all the time, but it's more common on the lower time frame, you know. And then when you see it, when it comes together like that, then there will be a value explosion in that scenario. And look at the explosion that we have. Even when you look at the trade that's coming from this upside, right? Even if you miss this, even if you've missed this, which is about 300 and something pips, let's say 370 something pips, right? What you will get at the back of understanding volatility squeeze and how that trade can be very low risk for you, can be explosive. Okay. So that's about 1,000 and something pips at the back of that little area. And it always presents a small, low risk as well. So those are the part of the strategies that I know at the back of this EMA strategy. Like I said, it doesn't happen all the time. But when it happens, what it's doing is this. It's now giving room you know, for a trend to occur, just the way that I've explained, there needs to be a wider gap between everything. Everything now needs to separate and calm down. The wider gap now needs to come in between the 633, the 200, the 36, the 12 EMA, and that wider gap now needs to come in again to start creating the next line of opportunity. So maybe we may have it
Can you zoom in a bit to, towards the left? I want
towards the left.
Yeah, keep going. Yeah, I'm trying to see on the chart if that even happened previously. See, look at that point where you are now. Move your cursor all the way to the left.
To the
Yeah.
left, this area.
Yes, yeah, that spot.
Yeah. So you've
I think,
got almost a volatility squeeze over there.
and
It's
even
not
somewhere
as
not
close as this
as
one,
yes,
but
as
yeah, even over here, you've got some volatility squeeze occurring over there as well. So yeah, those are the parts of the strategy of the EMA. But when you start to combine it with the other things that you've known and start to look at the way the trend is coming, look at this one, the trend, right? We are on top of the 200 EMA, we are squeezing almost around there. Although look at the way the price goes up, okay? And then the way the price comes back down again, and everything is looking for the 36 EMA rejection, the 63 EMA rejection, and then it's going to be a squeeze that's going to explode, and that explosion it generates. When you look at the returns, you know, the first one that I show you, we were just lucky to see that one. But when you look at the returns from here, sorry, choose the wrong tool. The price range. This squeeze to this squeeze, right? That's 161 pips worth of trade. And the risk is just the high, about 20 pips, right? 20 pips to 160 is almost 8 to 1, you know. Reward. You don't get it all the time, like I said, but when you know how to look for it, almost volatility squeeze over here as well, not exactly, but when you know how to look for it, it can bring in return and possible change of trend. You know, look at that high, all this area of what's it called, lower high, price continues to fall. If we put an horizontal line at the back of this, so you can continue to look at things like this and back test it as well. So that forms as an area of barrier, even when price push up back there, still forms as an area of barrier. Do we trade back above that area? Yes, we did, but trading back above that area, look at what it signifies. This trading, there's a trading strategy that some people look at like this. Although it forms this head and shoulder pattern, all right, this is just the last excessive move that the market can ever present. And then from this high now was the beginning of that largest short that we've seen in the market. And what caused that short? That we currently seeing. I think that is the COVID-19 situation. And you can see for even people who trade support and resistance, it's just that support and resistance has a problem that price can go above it. But when it fails, when a large support and resistance fail, or a very resistant fail, just the way that one, this one fails, the result was colossal. But how can you detect what's likely going to happen? If you don't understand the head and shoulder pattern, maybe you won't understand. But if you still can detect volatility squeeze and see everything coming together, that can still present a very huge opportunity that you can take advantage of. And once we hit that at 6 EMA and everything, even it's just the 12 EMA that's acting. And this is what keeps you in the market as well. I think Buki was asking one time, how can she continue to stay in the market? You know, the 12 EMA, in as much as it's still guiding price and price is not coming, to the 36 EMA, you still have every reason to remain in that trade. It can guide you a very long way. such that this is my explanation before we saw that one. You see, come back to that 36 EMA, you wait. Let's say the way that I trade this is I trade it with the Aiki and Nashi candle, all right? So when I'm trading it with the Aiki and Nashi candle, the exact strategy is this. If I'm looking for the, if I'm looking to enter a position, let's say for example, I'm looking to enter a position, I'll be seeing that the buyers are in control. Then I want to see that the sellers comes in by indicating a strong red candle like we've seen over here, right? When I see that strong red candle and it's approaching the 36 EMA, the first my trading will come in at this area, and I'll show you what the risk is going to look like. Just say for example, I will look at a long position, right? The price is already above, the 12 EMA is already above 36 EMA. Certain conditions are necessary. We've crossed, okay? We cross the 12 EMA cross above the 36 EMA, right? So I will be cautious to take a short when the what's it called, the 633 EMA is there. But when we blow above the 636 EMA, right, this will be presenting, it's a 1, 2, 3 strategy, which is going to be 0 to 1 over there. Okay, I need to wait for price to retrace back to 36 EMA, right, which I'm seeing over there. So 0 to 1 and then 2, sorry, 1 to 2 and then 2 to 3. This is 1 to 2, then I'll look at this as 2 to 3. So price need to hit that at 6 EMA. When price hit that at 6 EMA, then I want to see the first green candle. Okay, after the first green candle, my entry will be any trade that occurs at the eye of the first green candle. Because what I want to see is I want to see continuation. And there's no way that I can see continuation if I do not see price, a next price trading at least 1 pip above the eye of this particular candle. So if I take my trade over there, my risk will be at the low of the 2 to 3, and this is what it's going to look like. So it's going to be a long position. I'm taking it 1 pip above the eye of that last green candle, which means I have to wait for that candle to close, and I will take it at the back of that green candle, the next green candle, and the next green candle is going to be that particular candle. My risk, I will adjust it to the bottom of this candle, right? I can give it 5 more pips, right? So already I know what my risk is going to be, 59 pips, and then I will look for 3 to 1 at least. If I can't get 3 to 1, the moment I get 1 to, what's it called? The moment I get 1 to 2 or 2 to 1 rather, then, sorry, the moment I get 1 to 1, I want to move my stop loss to break even, right? And then once I move my stop loss to break even, I'll monitor the rest of the position. I know that I don't have no risk in that trade anymore. If there is any support and resistance at the top, I don't know where you find the support and resistance or whatever, then that can be another area of target for me. But yeah, we have a risk of about 50 something pips, right? And then the target will be at least 1 to 1 for me to move my stop to break even. If I get 2 to 1, most of the time I'll take trade position, right? So I'll close the first position 1 to 1, the second position 2 to 1, the third position I'll leave it to run for however how long. So I'll try and break down that trading strategy for you. So let's look at what we are looking at on that 1 hour again. Well, it's a trend. It's a trend strategy. Okay, it's not a ranging strategy. It's a trend strategy. So I want to see that the trend has begun or the trend has occurred, and what I'm looking for is for me to know that a downtrend has occurred. You see the way that we had this sell-off and this huge red candle at the back of everything, and then I need to see that the green candle comes in. That will show me the retracement. Okay, that will show me the retracement. And what I'll be looking for is this. Looking for the first red candle after this green move that hits the 36 EMA. So look at this one. You can see that this does not hit the 36 EMA. So I can't take this trade. It's not going to be in my strategy. So let's look at the trade as they are evolving. So over here, we have a move, okay? And then we have the cross, all right? So 0 to 1, 1 to 2, 2 to 3, okay? The sell-off, all right? And then we have the cross. If we do not have the cross, it will be trickish. Then I have to remember that this trade I'm taking is not a conservative trade, okay? So there is classes to the trade as well. When I'm taking a short position above 200 EMA and 603 EMA, it's an aggressive trade, okay? Because what is going on over here is we just add a cross, okay? And just because we have the cross, I know that direction has shifted, but we are still above what? Where the bulls will come to defend their position. And we are closer to the what? We are closer to the oversold area as well, where price can go back up. But luckily for this trade, this is one of the lucky trade. You can see how easy now that the entry will be this. The entry will not be this first red candle. All right, so that's the reason why I use the Aiki and Nashi to filter my position. The entry will come in on this candle, so I will be able to have the right necessary patience, take the trade on this candle. All right, so that would have been my entry, but the entry will come in 1 pip below the low of this. So when this candle close, right, this 1 hour candle close, 1 pip below it will be what? The low of this candle is 130.60. So my trade will come in at 130.61. Straightforward, I know what my trade is going to be. 130.61. All right. Sorry, the low of this candle, I was checking the eye, is 130.35. So my trade is going to be at 130.34. The low is 130.35.5. So exactly 1 pip, 130.54.5. That will be my entry. Wait. The low of the candle. Right. So I'm not going to be following the low over here. You see this low? This is the low that I'm going to be following. That low, 130.35. Right. That's the low that I'll be following, which is the low of this candle. And then my trade will come in at 130.34.5. Sorry. 34.
130. I think it's 130.55, isn't it?
No, it's
Put it back.
130.30. All right. So
One,
look at
put it
the
back.
low of this candle.
It's saying 130.355.
133.55 minus 1 p.
Minus 1 p will be 130.345.
Exactly, 133.45. So if this is 130,
Is it?
yeah, 133.45 minus 1 p. Right, 133.45. That will be my entry. My stop will be at the back of this eye. Right, and it's gonna be plus maybe another 5 pips. So 130.85. Right, in between both, when I look at the stop, that's about 50 or 51 pip stop. Okay, so I will put that one in the market, right, which means I can only use this strategy for a market order, right? I can't use this for a sell limit. So once that is in the market, my first target if I have 3 positions in the market, my first target will be that 51 pips down there. That will be my first target. And then my second target will be another 50 pips or 50, yeah, 50 pips will be my next target. So that will be at 50, 129. That will be at 32. Right? And then my third position, I will leave that one in the market for as long as the trend still remain. So, but this trade right here, right? Despite the fact that that's the first trade according to this strategy that I call, this is an aggressive entry, okay? The first conservative entry would have lined up every single thing. So the price has eventually come below, let me delete that. The price has eventually come below the 200 EMA, the 633 EMA, so which means we have confirmed that the bears are now in position. So what's the point of me taking a sell position when I'm taking it in the bull territory? You see the reason why it's an aggressive entry over there. Right. So if I want to really be short, I want to short when I'm confirmed, right? So that would be 1 to 2 and possibly 2 to 3, right? And then the reason why I'm drawing this trend line is I want my 2 to 3 line to be broken. I want the possible trend line that looks like that 2 to 3 to be broken. I don't want the price to still be inside the 2 to 3 before I take the trade, all right? So which means when we hit this 36 EMA, all right, the first red candle after we hit it will be me looking for a trigger, all right? My entry will be the next red candle that closed below it. This wouldn't have been my entry, all right? The icon actually will filter the color for you properly. Although this give us 1 pip below that, all right? So in some cases, I will find myself in a position whereby I've entered early just because I take the trade 1 pip below. Because 1 pip below this low will give me an entry at 129.10. So there's nothing 100% in trading. In some cases, I would have found myself in this position, right? Inside this position already, all right? And then I have this 3 hours of whipsaw, all right? But my stop will still need to be at the back of this eye, plus 5 pips or 10 pips, whatever is comfortable for me, according to my risk position. So my stop will be at the back of this. So that stop is 67 plus, and by another, what's it called? About another 5 pips, I'll be looking at 70 something pip stop, right? But the good thing about the strategy is this: the more you now boil your position down to a smaller time frame, the lesser your risk will be. The lesser your risk is, the potential returns may not be as high. All right. So which means the first position is this position. There's no any second position because we failed to hit the 36 EMA. All right. I won't be able to take this trade over here because we didn't hit the 36 EMA. I can never tell whether we're going to have this significant fall. Okay, I won't be able to tell. Over here, I'll just be looking at the charts. We didn't hit the 36 EMA. Then maybe I'll then be looking to take a trade over here. But by the time that I'm taking a trade over here, I'm looking at we've already reached the important reference point. So I will be very, very cautious to take this trade because I know that we are at an important low of the century or the year or the decade. That area, what you would usually get in that area is all this aggressive reaction, right? And when you get that aggressive reaction, you cannot really make a rational trading decision at the back of that. But yeah, so the 1 hour chart only present one opportunity. But when we zoom down to the 30 minutes or the 15 minutes or the 5-minute chart, you will see multiple opportunities when we look at that. So the one thing that I wanted to add to this again is simple. And the thought just came to my mind a while ago. So you understand when the trade is aggressive, if you are taking it above the area that you're not supposed to be taking it, that's when the trade will be an aggressive. It becomes conservative when you are taking it below the area or you find a volatility squeeze. But obviously you have to wait for this to evolve first of all before you can take it, because it's a trend strategy. If we look at the 30-minute chart and we look at the same area, we'll be able to find other multiple opportunities. All right, so this is a 30-minute chart now. So what I wanted to show you is this. The use of multiple time frame is important as well. If you can remember on the 1 hour time frame, okay, we got that trade. On the 30-minute time frame, we were able to get a third entry. But on a 1 hour time frame, that entry wasn't there. So this is 1, 2, 2, and then your 2 to 3, you have to wait till the price hits that 36 EMA. So we got an entry over there. All right. If we move forward, let me change this so that we know that that's a 30-minute opportunity. So if we manage to find a trend breakout, the opportunity is immense. Another opportunity comes in at 1 to 2. Okay. And then 2 to 3. But you want to make sure that you hit the 36 EMA. If you don't need the 36 EMA, then the trade is not going to be following the strategy the way that it's supposed to follow it. Then over here as well, you can now see there are multiple opportunities. Even over here, you can add to your position again. So this is how you can now start scaling into multiple positions if you manage to find a trend breakout. And this strategy is there is some kind of comfort at the back of it if you practicalize it and you start to follow it. So the 30 minutes time frame give us 1, 2, 3, 4 extra 4 scaling in. So if you find say for example you find a trending direction, then obviously other strategy might not work at that particular point in time. But for you to scale in or to know where to scale in or to be able to scale in comfortably, this strategy works for things like that, right? So every strategy has got their own strength and they've got their own weakness. That's the reason why you can't just know one thing. If you know one thing, you'll just be able to only apply that one single thing alone. And there's nothing wrong in that. But the moment you are approaching your reference area or your key reference area, then you want to be careful. You want to be careful when price is approaching that area, because now you would have get to the destination of that trade and then you can start to look for taking profit. So the strategy is good for trend. When we investigate this 30 minutes chart much further, when the price is in consolidation, you can see the crossing will be going on funny. The crossing will be overlapping one another. So the key that you are looking for is the gap between the 12 EMA and the 36 EMA wide enough for me to say that I want to consider taking a trade. And at the same time, you want to be looking for am I trading near those area of important support and resistance? You can see that when we get to, I don't know how we manage to find this area, right? Oh, sorry, my battery is getting low now. Right, so let's scroll back a little bit and see how we manage to find this area so that you can know the behavior of okay. So I think this is the area where we are talking about order block. I'm not 100% sure again. I think this is the area where we are talking about order block. That's the reason why I draw that. Remember, let me see. Not sure.
Yeah, I think so. Look at that. That was why you
Is it?
where we had all the square boxes
Yeah, we have some square boxes over here.
and rectangle boxes.
I've forgotten the reason why we put this square box over there, but I know we're talking about.
Excesses and
Sorry?
some kind you talked about excesses and some kind of other blocks. It depends on the language you want to use, like you said.
Yeah. I want to get it right. When we
This is the
okay,
very
oh right.
of
So we're not talking about other block over here. I think I was highlighting the fact that there is a support over here before that there's a support over here, then we have a 36 EMA coming in. And I was saying to
yeah.
you that now we are having some big important area of confluence, such that when price gets to that area, we can start to see sell-off coming back into the pound against the dollar. That's the reason why I have the over there. So it's because of this support.
Okay.
Right. It's because of this support. But I think that same support, if we extrapolate it, we have it over there as well. So what I was explaining on that 30-minute chart is for you to know what the behavior looks like when we are approaching key areas, or what you can expect when we are approaching key areas, and the behavior that you can see why you're not supposed to just quickly take advantage. So there was a support over here, and that support, for people who understand support and resistance more than I do, obviously they would have picked it from probably somewhere over there. That would have been the reason why I extended it. I don't know why the price is not matching up. All right, so that area. That area of previous support, because the moment price touch this area, we make a new high over there. We didn't come back to that area. So that area is key until we come back to it over here. So when price is approaching area of key support, obviously when you know that on your chart way earlier, those are going to be the areas where you want to be careful and areas where you want to be taking profits, should in case you following the price down like that. That is one key explanation that I wanted to explain as well. That yeah, don't really say that just because everything lines up and it's looking so trendy that you want to ignore. It's better for you to take your profit and then wait for what is going to happen, and wait for what is going to happen. And because in this area, it's easy to easily say that, yeah, the price is coming down. Then I come to this area now, I hit the 36 EMA, I'm looking for continuation. You know, that continuation didn't occur. There will be a reason why that continuation did not occur. All right. And then you are looking for more 36 EMA. And by the time you are looking at it, by the time you get into places over here, you're seeing that the gap is close enough. the gap between the 36 EMA and the 12 EMA, they are closing up. We have the 200 EMA. Easily, you will want to take a trade over here as well. We are hitting the 200 EMA because obviously thinking that what's it called, we come to defend their position. The sellers will come to defend their position. Then you start to realize that the price is finding it difficult to make a new low. And I've explained that as well a while ago, that when you start to see the failure like that, we have this low, now a higher low, another higher low, and then another higher low. That is giving you the indication to understand that those sellers are now becoming weak, all right? And then that can lead to break of price to the upside. So, and the same thing is what we are encountering where we are now. We see it much more clearly on the 4-hour chart. If you remember fully well this area where we are now. So on the 4-hour chart, it was much more glaring. So we hit an area of support, to refer to it in a literal term so that we don't complicate why this is happening. We hit it, so price come back to it again, we fail. Price come back to it again, we fail, and we are shooting up higher. But I was now alerting you to the fact that we did not hit a new high, right? So I'll be very careful. So there's a mix feeling over here. There's a mixed opportunity going on around there. Price can come down and start to shoot back up higher. We can't rule that out. Well, yeah, we are still in this big correctional cycle. We need to actually be able to move above this big correctional cycle for us to continue to go up higher. But yeah, everything is lining up positively for the buyers. It's just that the price, we know in this area on the longer term, we've got that 4-hour 633 is over there. If you remember, a huge resistance. We've got the daily 200 EMA if we refer back to it. So look at the challenges that we have on the higher time frame. So exactly. So the higher time frame is the challenge that we are facing over there now. The higher time frame sellers are exerting pressure, and we are finding, so the 673 is there, the day time frame, the 200 is there. We are not even moving closer to that one for now. So even when we overcome the 6, all right, so when we look at it this way, multiple challenges, and these are the areas where it will be very tough to be finding ourselves when we are trading. A lot of frustration will be setting in, and then we'll be taking some bad decisions. So that one is there. After that one, and this is how you know whether your trading location is good or not. And yeah, another thing is the 200 EMA on the daily is almost equal to the 36 EMA on the weekly. As you proceed, you'll be able to find certain correlations like this as well, such that weekly. Oh, I'm only going to do 12 minutes on this for everybody. Weekly 36 EMA. I didn't know that it would take me so long. Equals to daily 200 EMA, or around the same area, right? That is translating to almost the same area on equals to 4-hour 633 EMA. So we've got some huge longer term resistance coming up in those areas. And you remember the 36 EMA, right? Just the way that we've explained it on that smaller time frame, can start to be the beginning of further sell-off when it comes to price. So when we go back to daily 200 EMA, so you can see how that 36 EMA on weekly translates to 200 EMA on daily. So we have huge resistance over here, and we know that 200 EMA, always coming to defend. The bears are coming in to defend. Then on 4 hour now, when we go back to the 4 hour, then we start to see the 633 EMA. So the 633 EMA on 4 hour, it's more or less like the 4 hour time frame over
Overbought.
Exactly. Then when we go to the 1 hour,
Oversold.
you can see that the picture is now different. And this is what I'm explaining that yesterday, that if you're going to see changes on the weekly, you will start to first of all see the changes on the daily first of all. If you're going to see changes on daily, you start to see that changes on 4 hour first of all. So in this cycle, we haven't seen any changes. But if you're going to see changes on 4 hour, right? So now you will start to see
1 hour.
4 hour to 1 hour to either 15 minutes or 30 minutes. So if you're gonna see changes on 4 hour, when you start to look at 1 hour, you start to look for the changes. But look at this 1 hour chart here. The 1 hour chart is the first chart that's alerting us to what? What can we see on the 1 hour chart?
As if it's going to go up because the resistance is, I mean, the support is there on the floor.
Support is
You know what
there,
I mean?
but
Right on at the bottom, but there's a cross of the
all right,
top
so
and
there's
then
a
the
cross. So if you take a shot over here now, what kind of a trader are you?
aggressive one.
All right, so now you've become an aggressive trader. So, but I mean, equally, as you've said, there's a support that's lying over there, such that that support now is now looking,
But there are two supports,
lining
not
up.
just one.
Yeah, that support now is now lining up with our what? It's lining up with our 633, with our 200, but
Right.
I mean, we haven't got that much of volatility squeeze over here because everything is not lining up together, you know. But in places like this, we saw that explosion to the upside. So we just need to know that the next area where we need to watch closely is if price managed to descend down to this area, right? And then you can tally this area together with your trend line and still be looking for possible continuation to the upside. Depends on the kind of candle that we see. So that is where we'll be looking for the Ike and Nashi candle. All right. So now on the 1 hour, but the crossover now. So you can easily see when the trend is in play and when the trend is not in play. And you can see some trade in this position that can give you a sense of not wanting to take a trade. You get where I'm coming from. You cannot easily say that if I take a buy trade over here, I have full confidence in the way that it's going to turn up. So the risky trade is easily clear with this because the crossover is there telling us we are pushing to the downside. We've hit an area of resistance at the high already, you know, and now we have that 1 hour crossover. But if there's going to be a change in the 1 hour, where do we see it first?
In 30 minutes or 15 minutes.
So let's investigate what is coming up. So what's our 15 minutes looking like?
15 minutes. It's looking down. Yeah, well. So I don't know.
Yeah, so the 15 minutes, you can
It's looking
see.
down.
Exactly.
Looking down. Yeah, definitely looking down.
There's no need to be confused. The 15 minutes is definitely looking down. And when the 15 minutes is looking down, that means the changes that we are expecting on the 1 hour, it's not yet ready. You get where I'm coming from? The changes that we are expecting on the 1 hour,
and then you can see the prices. Prices subtracting the 12 EME now, forming a trend without EME.
Exactly. So and there's a wide gap in between in between them. So the buy trade is not yet definitely ready. Well, if there's going to be a change on the 15 minutes,
5 minutes.
look at the 5 minutes. So part of the strategy in between the 200 and the 633 EMA, that is one of the most risky trade that you ever want to take if there's no taking. If you do not know how to approach, when you start to see this huge gap, this one is called volatility gap. Okay, so we have volatility squeeze, we have volatility gap. When you start to see the volatility gap, right, price can jump inside this and make a lot of up and down inside it before it makes decision. Okay, so when you have trade coming near the 200 EMA, right, your next target is going to be the 633 EMA, and then you can expect that price will play when the gap is large. You can, in some cases, the gap is not wide, but
can you see that they're coming together again towards the head, where the price is at the moment? What does that
over
mean?
here. So everything is coming together, but you want to see them squeezed up together. They are not, it's still showing you that all those averages, all the price averages is not ready. That's the reason why you're going to understand that this price going up and down, you cannot view price with a single or look at price as a single entity. There is always something combining together, or each and every price is different to one another. So it doesn't, it has not come to, they haven't come together. So that volatility squeeze is not there for now. But when we look back,
it's not there.
Yeah, when we look back, we will be able to see more example of volatility squeeze. In this area, we have almost such an example. There was a breakout, retracement back to that area, and price is using it to move up higher. So, yeah, but we can look back and look back. So do a lot of back tests to look back and then see what kind of opportunity that we can come up with. And at the same time, I believe by now you understand structure. We have a squeeze, right? When we have a squeeze in one way or the other, we are trading towards an area of support and resistance, okay? If that area of support and resistance is not broken, that would have been an area whereby we want to take a what? Where we want to take where we want to take profit. But I mean, I don't know whether you understand what I'm trying to explain over here. Look at the price over here, right? The price has made a low, hasn't it?
Yes.
All right. When the price make a low, we make a failure to make a
lower low.
A lower low. So there's no trend to go downwards anymore like that. You get where I'm coming from? So we push up higher, we have that volatility gap in between. Price we go in, come back out. You will always see that when there's a huge gap like that and price manage to break inside, right? Price we want to go in and out. So all this is going to be alerting you to price is not ready. If I'm going to take a trade over here, it's going to be a short-term trade. So that's one key thing that the EMA can do for us. So it's going to be a short-term sell-off, and my target is going to be the 200 EMA. I don't want to joke thinking, I've seen it happen one too many times. I don't want to joke thinking, yeah, so when we come back to this 200 EMA, we will just go back up. All these places, price is still preparing itself to be ready for a decision to be made. So you can see now this is a huge support. Having this level as well would now be another huge area of support. When you take a short, right, and then price is approaching support, that trade may not really work out. The reason why it won't work out is this is not just a ordinary support. This is one huge level of support. This area here has already shown us a failure, and then we come back to test that area, and then obviously the traders who are buying support are going to come inside the market. So one thing you want to understand is as the trend started, so you need to time your higher time frame to see the beginning of the trend. When you get a volatility squeeze, it's an opportunity trade, you know. So this 5-minute charts can be giving you also different kind of fake out signals, but you know that this is your high area over here, this is your low area over here. That's what the price is respecting. You can adjust it again. You have a reason to adjust over here on the smaller time frame to see this low and see that. And obviously what we are looking for is price to come back to this area over here now. You know, I mean, when price gets to this area, we can possibly find ourselves in a position whereby we may not even be able to break down this area and start to go back up. But yeah, right now we are not yet ready. Until we get down to this area now, we're not going to be able to make any cogent decision, you know, as regard to whether direction is going to change or not. So let's be careful watching it. I mean, look at various examples, and you have opportunity to ask question as we proceed. I hope it's a little bit clear. I mean, look at various other we can look at various other pair, but let's leave it as at where we are now. Do a little bit of assignment over it, play around it, you know, but look at the bigger time frame and then see what you can possibly make out of it. You'll be seeing the trade coming in little by little, but what we want to see is, okay, no problems. What we want to see is the beginning of a trend. You know, we want to actually see another trend coming up. But it is evident in the pound against the dollar now that there's no trend developing from all our analysis that we've done from the big time frame to the small time frame. Excuse me, we are in a consolidation, so we can use the EMA trend to see that it's so glaring, and then we can look at other pairs to see how trend is going to develop going forward. I hope you all enjoy it. I'm going to be calling it a moment for now. I want to say thank you to Wumi, Uche, Jumai, and Shegun for joining in. I mean, Shegun, I'm not sure if we're going to be able to do anything again tonight. Someone definitely requested for this class, and I have to do it. So sometimes I'm just a little bit busy in so many ways. No worries, guys. I hope you have a lovely evening. I mean, obviously, if I can come back on at any point again, I will let you know. But yeah,
Thank you
let's.
so much.
No
Thank you
worries.
so much.
I hope you
My
enjoy
internet
it.
is messing up now.
No problems. No problems. So if
But
you have any
no
requests as well, don't hesitate to bring in the request. I mean, this is recorded. I'm gonna post the recording for you so you can have it again. We just base it on AMA. We know that this is a class that we just basically look at on AMA alone. All right, and you can replay it over and over again. So
All right, thank you, sir.
no worries. The key point to summarize, right, and to understand the strategy, we talk about volatility squeeze. Just to refreshing the memory, when AMAs combine together, expect explosive as much as we can two. Volatility gap, careful price strength, wide gap. So key, check somewhere over here. Probably the keys. It's a wide gap. Good. Six. We find it. Hold on 1 second. Yeah. Swear to God. Volatility gap. And there is bounce trade as well. So the bounce trade is what you see on the 633 EMA when the price has suddenly overbought trending market. We discussed that as well. In a trending market, retracement, EMA, the paper, one paper above or below the trigger and the strategy itself, number 5. System 3 EMA 2. So if we look at a bounce trade example quickly, when we go back to that 4-hour chart, you're looking for a key candle to form like a doji Although on the what's it called? So you want to see price going into the what's it called? You want to see price piercing the touching the 633 EMA. In some cases, that candle can form a rejection candle like a doji, or you want to wait for a doji such as that, and then the next green candle, and the next red candle, and then you can take that trade from 163 EMA then back to the 200 EMA. So you want to be careful when you are inside this gap. If you remember as well, you can see that we are inside the 4-hour volatility gap. The price until everything tends to converge together, right? Then we won't really see that trend explosion that we are looking for on this what's it called, on this pound dollar. Now you can see that we are still trading the volatility gap of 4-hour to in between the 4-hour and 36, sorry, in between the 4-hour 633 EMA and 200 EMA. So there's no magic that's really going to happen immediately on this pair for now, because we are inside this volatility squeeze until everything converges together, right, and start to face off. Then we can have that huge explosion to the upside. So for now, you can see that there's no magic that can possibly happen for now until everything converges together. Look at this. Everything converges together and then shift in direction. Before everything converges together, look at this 4-hour. We are just bouncing in, out of that, what's it called, of the 33 and 200 EMA. Okay, so the same example that you can see over here, look how long it takes. The first time we break, let's measure it. Sometimes I feel like I should just stay in the classroom the whole day, but
It's what you enjoy.
exactly, and sometimes it's not just possible.
I
If
know.
I even so look at that, it has taken 23 days. Because it's like if I need to open people's eyes, I just want to open their eyes for them to see. This is 97 bar. Well, we've done 22 days on this one. So the trade that you can be witnessing inside this volatility gap um, is a large correction that you can be witnessing over there. The moment the price bounce through it and start touching one another like that, it can take a bit of the time. And this is a 4-hour chart. Over here, we are very struggling to come in between the two. But yeah, opportunity comes in when the price moves from one part of the 200 EMA to second part of the 693 EMA originally, I mean the first time as well. So the timing is very essential the first time as well. Then you can easily see a bounce back up to there. It can be bouncing back and forth. Let's look at another example. Volatility gap with trading between, you see how they are just using it as a play ground insider play. So once, even if you are doing other strategy, if you are taking another strategy and then you just bounce back quickly, let me see exactly where we are using the EM. Oh, so we are inside a place like this. This is it. Instead of me to expect that, okay, I don't have EM, I don't have anything to expect. This is a trend going on. You know what I mean? When I realize that we are inside this place, it's a caution. I can easily understand when changes is coming in. Another example, inside the volatility gap, you can see bouncing in and out. The law of madness happens inside that gap. Inside that gap, the law of madness just happening there. It's more or less like price want to reach the end of it and always come back down to the bottom of it. And sometimes you see a trade like this, you don't really know what's going on. But it looks like as if we've already started going up, and then price will bounce back down inside it, and That's the function of volatility gap. Almost the same over here. Side trade inside there is always risky. You can really see that even if you want to have a definitive direction, and these are all the challenges our traders face. If you want to have a definitive direction and think that okay, we're going up, if you don't have the EMA, maybe that's what you're thinking. But now that you see that you have the EMA, you can look at it differently. No problems. You will always learn something. So, but when we are outside of that volatility gap, it's more or less like on your own type of a movement. But the moment we start stepping back inside it, this is our volatility gap. We don't manage to step back inside it. But the moment we start to step back inside it, we can see madness going on. So yeah, and the settings for the EMA that I use, 633, 200, 36 EMA, 12 EMA, you can trade that profitably as well. By the time you add your market structure and patterns, you will be able to see some definitive, what's it called, trade opportunity. Look at it again inside the volatility gap. All right, so many examples. It is not a joke. It is always there. And where are we again? So now we can now, by back testing, which I will expect everybody to do and post charts onto the chat room. That's why we have it there. So that, I mean, when you do that and you can even post the charts into the chat room, you will realize that you've done an assignment, you've learned something, you identification, right? The journey to become a trader, if anybody does not know, but from the time that people have been following me, they will realize that the evolution is not just a day evolution. I can't make you a profitable trader in one day. It's impossible, because I'll give you one strategy now. Suddenly it might look like I say, is this strategy working? It's working, but the conditions that are present will not make it work at that particular point in time. There's nothing you can do. If I didn't give you this in depth now, and I said, don't worry, anytime you see 36 EMA and this retracement, just take it. If everybody can do it like that, everybody will be a billionaire in trading in one single day. So it's not a joke journey, but it's an evolution. You'll be evolving little by little, and you'll be discovering new things, and it will be so fun sooner or later that it will become boring, and the trades will just be coming into your hands like a joke, because now you have a key understanding to a point whereby you can, there's nothing the market wants to do that will look so special to you. So the other thing will now be, how are you recording your trade? How do you understand yourself? We haven't even done any class on that one at all. Self-understanding. You need to be able to understand yourself. You need to be able to observe yourself. For example, you can just be on the trading screen sometimes, and you start to do something stupid, and just because the moment you enter this world, every other thing is not part of you anymore. It's like a different world entirely. You will become so immersed, and then you'll be taking some risky trade, and then but the moment you start to have structure at the back of your trade, the moment you take that risky trade, should be able to call yourself back, close that position immediately. Even if you've lost money, it's better to lose a little bit, right? It's more or less like if I say to you, take that trade at the back of 36 EMA, and you just say to yourself, I've seen that, you're welcome. I've seen that it is 12 EMA, and sometimes, we look at a trade over here before I put in the Ike and Nashi. If I put in the Ike and Nashi, we look at a trade over here that everything looks like I see on the candlestick chart. All right. So, and it's a good thing that I even remember this again. On the candlestick chart, everything looks like as if it touches the 12 EMA, it bounces back up, touches, bounces back up. So you can then decide to say that, okay, yeah, what I want to do right now is I'm going to be taking my trade at the back of the 12 EMA, you know, and I said, okay, take that 36 EMA retracement. That's what I only tell you that use the 12 EMA to watch for trend continuation, you know, because it's not all the time that the price touch the 12 EMA that the trend will continue. Look at where we are over here. So you now decide to say, 12 EMA, let me take this buy opportunity. You took the buy opportunity, you've forgotten for one reason or the other that the 200 EMA is there, and then you are expecting continuation, you know, and then the suffering start coming in. But the moment you realize that you took that trade at the back of 12 EMA, oh shit, even if this thing is going to continue, probably the price has hit over here, and then you now say, 200 EMA. It happens to everybody. You can't become a guru in one day, you know, and then obviously you see that. The best thing for you to do is take that position off, right? You know that you've gone against the strategy. Leave your computer, stop every single thing, leave your computer, take a walk away from the computer. We as a trader, what we are fighting is completely different to what normal people are fighting, because we are fighting emotion to be able to become that professional that we want to be. And we know that the only thing that we need to be able to do that is we just need a chart in front of us, and then that chart we need to see certain behavior or certain opportunities coming up. And then instead of us to be able to wait for that, every day we want to make money. Who doesn't want to make money every day? This is an opportunity to make money. There's no lie about it, you know. But in that same opportunity to make money, there are some challenges. You know, the market requires you to be patient. It's more or less like we not investigating this properly and not thinking about volatility gap and not back testing, and we just say to ourselves that, yeah, when the price come over here, let's just buy, you know, price, or let's just sell or whatever. And then we've forgotten that, okay, so even if we just buy over here, there's still a volatility gap over here. That's the reason why the completion of the strategy is so important, especially when I'm trying to give it out in a way whereby I want people to actually benefit from it. You know what I mean? So we buy over here now, and I forgot completely. It does happen for me to even be able to tell you that when it gets back over here, try to be looking to take some profit because we are inside the volatility gap. You know, you can have blindness. Price can blind you, whether you like it or not. Your eyes will be wide open like this, and price will blind you. There's nothing you can do about that price blindness. It occurs. There's so many things that occur in this business that each and every day as we grow, as we develop, I'll be bringing them in. You'll be seeing them. You'll be able to make use of them. You will sit down and laugh at yourself one day and be like, wow, I've done this before. I've done this before. I've made this mistake before. It's all about making that mistake. But when you make that mistake, record it and then go back over it. If you don't start to record your mistake, right, it will be very hard for you to succeed. All those trades that you've lost, right, all those losing trades, I know the emotion at the back of it is, oh my God, I lose this trade. Oh my God, I've lost money. Oh my God, I could have done it better. That will be that immediate emotion, but you need to have a record of it so that even at the time you want to go back to bed at night, probably you just open it up, maybe a picture of it that you've written something on like this, you save them, probably on your phone or somewhere, you just open it up, look at that silly mistake, you know. By the time you look at it over and over again, when that silly mistake is about to occur again, you will never make it because you will remember it. Now you have a picture of it. It's more or less like, how do you recognize that probably this is my auntie coming? Because if you haven't seen that your auntie before, you may pass your auntie and not even remember that that's your auntie. But the auntie that you've seen over and over again, that you have rapport with, that is the lost trade. Lost trade that you've seen over and over again, that you have rapport with, that you look at, this, you again, you're coming to me again, you again. Because we always find ourselves in that zone where we forgot. There's no doubt about it. It happens to everybody. There's no any genius when it comes to this, especially in the developmental stage, you know. And that's the reason why when I teach, I take my time not to just rush into giving it out. I take my time to find a way to immerse it in, so that at least you can get it, so that I know that I go through it, so that I can feel like as if I do my own calling, and I know that you will be able to absorb it, you'll be able to come up with it and do something better with it as well, Titi Layo contacted me the other day. We look at some chart together, and she does not even know that she's looking at a winning trade. She just come up with a brief, and I sent it into the room as well. And I think it was this trade, yeah. It was this lovely trade. She just come up with this harmonic pattern, and that was the only thing that she was looking at. Then I was like, okay, don't let us just look at the harmonic pattern alone. Let's look at some other few things that revolves around this particular chart. So I put in, when I do my own analysis, sometimes I would have forgotten to even take off some few things. The charts will look so messed up, but I know where I want to arrive at the end of the day. So I put in some few key things, like, okay, let's look at it like this. Definitely we know we are in a correction. In a correction, we know that we are looking for the end of that correction to either give us continuation, right? So when we were looking at this particular trade, I started to tally some few things up and look at the swing all the way down. We are having that correction back to 50% retracement, okay? I'm looking at the inner correctional cycle. I can see that we've reached the fifth leg of this: 0 to 1, 1 to 2, 2 to 3, 3 to 4, 4 to 5. And I know that, okay, at the fifth leg, we can definitely expect that drop. That drop, look at that. We tally this eye to that eye, even to an eye over here, okay? Kill the price. Literally, we did not give that price a reason to breathe, but it was late when we were doing this. All right, so we find every single reason for this to work out. That, okay, even if price choose to break this, when you look at this, this is first touch, right? I taught this yesterday as well. Second touch, right? The third touch, okay? The price break out of the third touch. If price breaks out of the third touch, and when we are looking at this, price hasn't even break out of the third touch. What else is there that can hook price? The next thing that was there that can hook price, look at what hooked the price. What is that? 50% retracement, okay? So the price even eventually take the piece. Card is a lunatic. It will do that. Eventually take the piece and do that, break above, you know what I mean, into that 50%. So I'm looking at that 50%, I'm tallying it up, guiding it with this upper channel of trend line, things like that. They may be difficult for some other people to do, but we know our objective, we know what we are looking at, and then we know definitely at a point in time something will definitely have to happen, so we mark the area where we are expecting, irrespective of whatever the case may be, madness should happen. Irrespective of whatever the case may be, something will definitely happen. I don't have a crystal ball. I am not better than you, I don't want you to, and look at it, it's just a 20 something pips worth of what's it called, worth of buffer up to that area, okay? 20 something pips. Now look at the trade. 190 something pips we took out of that trade, and when you start to put your analysis in the room, okay, I will take my time, and that's one thing I'm trying to do now. When you start to put your analysis in the room, I'll take my time now to make sure that I tally every single thing up to see where that trade can possibly work. When she came up with it, let's see, City Lion. that is the power of every one of us doing things together. Because one single trade like that, all right, so this is our beginning. I think, let me check this chart, card Swiss. So she did this analysis at first, you know, she looked at it that way. That's it. To we move back above that trend line. Then after that, she didn't leave it alone. She didn't say, all right, so this is what she now sent to me, that, boss, did I get this harmonic pattern right? So I pull up my chart, I look at the harmonic pattern. I was like, okay, so you didn't get the harmonic pattern right. This is what your pattern should look like. I show her what our pattern should look like, what the ratio should look like. So this is the beginning of me trying to do the analysis. And then I'm looking at the area, and then I put in more in-depth analysis, I'm putting more in-depth analysis, I'm putting more in-depth. All right, so when we do that, you can see that. So I was tallying every single madness together that I can possibly tie together. And the trade has not even occurred when we were doing that. So things like this is motivation, not just for you alone, motivation for me. And then when I first of all sent her this, she was confused. You know, I would be thinking I'm interacting with so she said, I'm so confused, you know. Okay, I was like, okay, you're so confused. At least I'm not doing a magic. If I'm doing a magic, then maybe I won't have a full evidence proof and explanation to what I do. Then I started little by little. I put in the 50% retracement for her to see, first of all. That's where the price was heading to at this point in time. The price hasn't get there, but the price was heading there, you know. Then I start breaking it down for her little by little like that. I start breaking it down for her little by little till she understands. And out of that, me doing that is not a waste of time for me myself. You know, it's a lesson for me in a way that I can impact the life of people positively, you know. And if we manage to catch a trade that is sensible, that is positive like that, and we take it, it's an opportunity for every one of us. So this is a never-ending grace for all of us. Let's just take advantage of it. All right. So don't relent. Don't relent. Bring in your charts to the room. Let's have a look at it. Let's put in analysis on top of it. Let's make something out of it. And then you'll see that in combined effort, your thinking alone can lead you to that twilight zone whereby you'll be lost. But when we start to share it together, right, I will be able to use my own little experience to open the horizon up. You will be able to see it in another way. You'll be able to bring in more sense into it. We'll be able to bring sense into it together. We'll be able to get an impulsive move. That's all we're looking for. At the back of this impulsive move now, what do you expect? We see expecting possible continuation because we haven't even get down to this low of the pattern, you know. So there's see more opportunity over here. If we look at this on, let's say, for example, now that I even remember. So when we put card Swiss over here now, then if I put it on, say, so it's on 4 hour now. If I put it on 1 hour or 30 minutes, so we can still be looking for opportunity for a retracement back to this 36 EMA. You can see the wide gap already. So that is an excitement to know that, okay, this is a trade I can jump in on. You know, I can see a retracement back to 36 EMA. If it's not occurring on 1 hour, let me zoom back to 30 minutes, you know, and then the opportunity might come in on 30 minutes, you know, in as much as there's no any support and resistance holding price back over here. All right, so there's a support. So you can see what's holding price back in one way or the other again. So, well, there's still opportunity over here because there's a wide gap between the 36 EMA. All we want to do is time it out of this support and resistance. And if we are inside this support and resistance and price decide to shoot back up again, take it. take it because the price ended on this exact support, but I don't think this price will stop where it is. The reason why this price is not going to stop where it is now is this. Look at the structure. When this structure is broken, okay, it's completely different. This support and resistance, all we are expecting it to do now again is to shatter it off, you know, because the major structure that's holding, that's keying the chart together is no more there. We've broken out of it. So that's the reason why I'm not thinking this support and resistance has got any definition on this chart for now. Okay, so, but yeah, we keep an eye on it and then see what we can do going forward. So I wish everyone that's been part of this call a good evening. Let me take a little bit of rest, and then the market is opening very soon. And then we'll see what we can do. Just keep the chat coming. You can relent, okay? The opportunities are there in the market. And have a lovely evening, guys. Let me take a bit of a break. Thank you.
Thank you. Bye.
No worries. Bye.
God bless.
Welcome. And you too. God bless you too.